Hi, welcome. It's John Gillingham from Gillingham CPA. Today, we're going to be doing the Small Business Tax Planning Seminar, where we're going to be looking at key things for particularly the new small business owner who's just starting out, needs to focus on. Estimated tax payments. I'm going to keep this really simple. When you're on your own and you're making money, you're going to be owing a good chunk of change. So please find a certain number to get you in the ballpark, whether it's a 30% or 40% of your income, and save it. Save enough so it'll give you, one, the flexibility to pay the tax, two, the ability to tax plan, and three, take advantage of some retirement accounts that might actually put some money back into your pocket. Please be ahead. It's worse than a credit card, IRS debt. If you get behind on the state of California, pay up the state, get your taxes filed current for federal, and then work out a payment plan if necessary. Always file an extension if you're going to be past April 15th, the file deadline. Now, estimated tax, real numbers 2014. Please, I disclaim everything here. Just know this is one particular kind of situation to give you a real ballpark. And I really want to focus in on this $20,000 self-employed income profit. How this could possibly look is someone makes 20 grand, they're living in San Francisco, and they owe a total of $3,776 of tax. Someone earning $20,000 working at a fast food restaurant would owe nothing because the fast food restaurant would be automatically withholding all of the tax related to self-employment tax, meaning Medicare and Social Security. So that same person goes out and starts their business, they're going to likely have a huge difficulty scrapping up that money. Now, when we start moving on into the $40,000 camp, we're looking at owing about $10,000 across the board, or 25%. So a lot of this reason that small business owners constantly complain about taxes, a huge reason is because now they're responsible for the self-employment tax, and they're painfully aware of how much they're paying. Now, these numbers assume single filer, probably just very basic, nothing going into here, just to give you a real ballpark. Generally, believe it or not, I tell my clients, save 50%. I know that's a lot, but 50% of your profit. So let's say you pull in $1,000 and you're just straight pulling in money, no significant expenses, save the $500. If you're making $200,000, you'll have 40% going to tax and 10% for savings and flexibility. Maximize your deductions, everyone. There's a lot of different things that CPAs can do to help you with this. But unless you provide the necessary information to those helping you, it's going to be difficult. So, a good CPA will talk to you about assets previously purchased, not used in business previously. For example, if I have $3,000 of computer equipment and video recording equipment that I use directly in my business, I can take those assets and contribute them to my business and then take the expense over time in the form of what's called depreciation. Don't forget about credit card interest that is completely related to business. Mileage expense. Boy, 99% of my clients take the standard mileage deduction. Standard mileage, for example, say whether it's 55 cents a mile, 50 cents, 70, whatever it is for the particular year, it generally is a lot better than the regular car. So here's the thing. The IRS, they've been playing this game for cars forever. They're not going to let some business person, probably from LA, buy a Ferrari and write the thing off on their taxes. They're going to limit it. So even though it's an actual business vehicle with $500,000 of costs associated, the IRS is going to give you a teensy-weensy deduction. So small that actual business expense for automobiles rarely helps unless you're driving a dump truck around. So please keep track of all your mileage in a mileage log regardless. If you want to go the actual expense route, make sure at least 50% of the vehicle is used for business and you have a very solid, legitimate business use for the vehicle because you do report personal use on the tax return. So generally, keep track of your mileage, get a mileage log, and you will be in much better shape. Don't forget about your cell phone. Home office. Let's discuss home office for a moment. It sort of irks me when a lot of CPAs say, stay away from the home office. It's a red flag. Don't do it. If you have a home office, it's exclusively used for business, it's primary, it's functional, it's important, and that space is allocated to your office, you should highly consider taking it. Now, you must read through the publications or discuss with the CPA as to whether you're qualified. There are very strict qualifications. However, if it's legitimate, you should absolutely take it. I don't think it's right when clients say, I'm trying to avoid an audit, so I'm not going to take this legitimate deduction. That personally makes no sense to me. So highly consider the home office deduction. It can also help in being able to deduct some of the other transportation expenses that you might be incurring that's directly related to your business. A lot of rules associated there. How it works in general with the home office is that you have your regular home. And let's say you just rent it for simplicity. It's 1,000 square feet and 100 square feet as the office. Therefore, 10% is your home office. So this is your gross expense a year. $10,000 a year, we'll call this the Midwest, for 1,000 square foot, 10%, you get $1,000 deduction, which depending on whether you have a profit or loss may or may not be actually deductible to you. However, some of those losses may carry forward. What does this all mean? Look into it. Taking home office deduction, even if you don't get it in the current year, can have great long-term impacts. Your commute is never deductible, but business travel is. So please, if you're combining a trip, you have to go to New York for business and you see your mother-in-law along the way, there could be some great ways to still deduct that trip, assuming it was indeed for business. Now, also per diems, costs of travel are all specified in IRS guidelines. Publication gets a little bit tricky, but those deductions can be a gold mine for you. Now, let's just talk honestly here. If it were up to me, I would probably pay someone else to do all of my taxes for me. Wouldn't that be nice? Sounds good. You just hand them the box of stuff, you do a little bit of your research, ask them a few questions, and it's done. That's how small business owners should approach things, is that their time is valuable, and once you're making over a certain amount of money and you can afford it, there's no hard rule of thumb. You should absolutely get a professional helping you and something that is a good fit. So let's just run through some of these here. Fit is the most important because if you are the squeaky wheel at a firm that's used to much larger clients, they're not going to pay as much attention as you think. You want to have candid conversations with people who might be possibly offering you service about as to what this firm can offer you, what other type of clients are in the firm, and what you value, whether it's business deductions or projections. Maybe your business is seeking financing, maybe you need practical advice, maybe you need really complicated advice. So you can get $80 software fired up. The advantage to that is you have to learn a lot and try and figure it out. Once you start making a certain amount of money, don't mess with that. Please don't be cheap. Walk into Prep Shop. You can hop in your car and find some somewhat shady shop and get your taxes done for $250. You might get a good person, you might not. If you have a referral to someone, these people can be really quick. They're incentivized to do your taxes as quick as possible. So these are prices for just the most basic tax return too. So consider that as just another option. You can get a solo CPA or EA, EA is an enrolled agent, means they have taken some classes regarding tax and taken an exam. And that is about $450 to get everything, and a fairly basic return from a CPA firm in California or New York, high-cost areas, can be as much as $900 with just a Schedule C with some decent earnings on there. It's just expensive. There's a lot of costs in software, time, offices, and everything else. The larger CPA firm, they won't always have the time to give you the best individual advice or spend enough time with you. However, they're going to be very compliant, very thorough, and get 3 sets of eyes on the return. And whatever you give them, it should and will most likely get into that return. Sometimes you need the CPA. So you're looking in to try and get your taxes done. Understandably, there's different levels of service. Do you want the white glove? Do you want everything perfect? Or are you the do-it-yourself or the Home Depot type? It's like, do you want to have a contractor to have a structurally sound house? Or do you want to go to Craigslist and get your drywall patched? It just depends on what you're looking for. So I'm going to walk through a few of these very practical guidelines. You know, you could do your taxes for $80 with software. Advantage of that really is you just sit in your house, maybe you learn a thing or two. Not terrible. You can go get the walk-in prep shop around $250. That's not necessarily the best solution in the world because you just don't know who you're getting. If it's a referral and it's a low-cost repair, maybe it's okay. Now you're talking more reality here is solo or small CPA or enrolled agent, somewhere around $450, something like that. Or a white glove, a larger CPA firm, somewhere around $900. So sometimes you're stuck with that because things are really complicated. It needs to be perfect. If you have foreign things going on, multiple partners, investors, you're going to just want the white glove CPA firm. But for most of the solopreneurs, solo clients, I think in the $450 range with estimates, tax return, and getting your questions answered. Find a fit, someone who's going to answer your questions, spend the time with you where you want to spend time on. What do you value most? When a client comes to me and says, I want an aggressive CPA, I run the other way. I don't do that, no way. But if you want to talk about retirement accounts, extra legitimate deductions, you want to talk about your kids' college, different ways to save, different ways to pay your taxes more efficiently, that's great. So find someone that's going to value what you're looking for. If you're looking for funding, Series A, Series B, I don't do a ton of that. I do very small startup stuff all the time, but do I have, am I accustomed to $10 million fundings? No. So that wouldn't be a good fit. So I'm honest about that. It's going to be me in a few years. We're just going to talk a brief while about different entity types. Sole proprietorship, you're by yourself. That's probably you. You're scrappy, you're trying to save money. You don't have a business entity form. If you want to start taking checks in another name, you can. That's called a doing business as. You go to City Hall, you file the right paperwork, you put a little thing in the newspaper that says, John Gillingham doing business as Awesome CPA Company, and now you can take checks to Awesome CPA Company or whatever that may be. It's a very simple structure. It's fast. God bless America. You can just start working and you're in business for yourself. The thing that gets people in trouble, though, are those estimated taxes and all the compliance that you have to do. So very easy to just open up shop, but then you have the compliance side, as we discussed. The S-Corp. S-Corps are a flow-through entity, so they avoid a double taxation. They have limited liability properties, which are great for high-risk businesses. Most of the S-Corps I see that are very successful, they're very high earners, or they're closely held companies, if not only one owner, and there's some great tax advantages once you start earning a significant amount. And by significant, I'm going to say 70,000 plus, but more maybe like 100,000. State of California, $800 to be an S-Corp. That's a lot. So weigh your costs and benefits and always consider insurance, liability insurance, as well as your entity decision. Limited liability company. Limited liability company. So this LLC structure is really good for flexible flow through, so there's not the double taxation issues that C Corp is going to have, and you can also divide up things differently. On the S Corp, everything is right down the middle. If it's 50-50 one year, it's 50-50 the next. A lot of inflexibility. LLC, lots of flexibility. Nonprofits, 501c3s, other various structures outside of the scope of this particular presentation. However, just know that it exists. It takes a lot. So if you're starting up a nonprofit, do your research. Public benefit, also do your research if you're interested in that particular space. Saving money for retirement. I love retirement accounts. Be careful about fees. If you're rewinding back to the LLC fees in California, $800, more structure, more cost, more complication, and there might be questionable tax benefits. So you have to think the lawyer's going to want to sell you incorporation payments, the CPA is going to want to run the clock, maybe, and the investment guy is going to sell you investments. So just be careful with where you're putting your money and take everything into account as far as those regards. There's a lot of different retirement accounts out there, different options. There's another thing if you make very little money called a retirement savings credit, in which case you can sometimes get a tax credit for contributing to accounts. If you have a lot of money on the side, a strategy that I love to utilize is a solo 401k. So let's say you have $100,000 sitting in the bank, your business is not doing great, but you might still be able to contribute a massive amount to a Roth 401k, which is a strategy that not many people know about, not many people talk about, but it will allow you to get some of your existing savings legitimately into a great investment vehicle. And let me preface investment vehicle, a tax savings structure. These 401ks, these IRAs, these acronym alphabet soups, they're not the investment itself. That's just where the cash goes, and then you decide as to how you want to invest that. So if I say, oh, hey, Mr. Client, would you like a Roth IRA? And they say, I don't trust them Roth IRAs because they lost money for me. Well, it's not the Roth IRA that lost money for you, Billy Bob. It was the investments within the Roth IRA. So I don't mean to poke fun at Billy here, but just having a little bit basic understanding of these accounts add up tremendously over time. Even at, say, $5,500 a year, $5,000 here, $5,000 there, assuming the investments make a little bit of money and they grow over time, you can have tremendous tax advantages that could take a whole hour discussing, but just know that it's an option that you want to have cash for in order to utilize. Also, do not neglect the SEP IRA. That's kind of like you can do a lot after the fact. And just the solo 401k is something that you have to do during the year. So tax planning, having your books and records up to date becomes particularly important when trying to figure out how much to put into your retirement account.